focusing on what we saw where you are in Singapore with the MAS and the surprise tightening, I have to wonder, are Asian central banks now more forced to realign themselves with the Fed as they deal with more surprising inflation prints?
So overall, I do think we are moving towards the path of tightening in a number of different economies. But stepping back, I would say Asia, maybe not exactly across the region, will have three camps in Asia. The central banks who have been, in fact, ahead of the Fed move, the central banks who will probably follow the Fed move, and the central banks, specifically in case of China, who will be on a completely different path of easing. So it's not a very synchronized story of monetary policy tightening all across the region, but on the margin, the inflation certainly is ticking higher, which will lead to some of these tightening moves in most of the economies, not all.
So when you look at your world of Asia credit, I'm just wondering, given just this fiery rotation that we're seeing in stocks right now, this bond sell-off among the sovereigns, is Asia ex-China credit still a good place to seek shelter?
It still is a good place. And first of all, again, taking a step back and thinking about the Fed policy. If the Fed policy is coming alongside the growth, which is still okay, and potentially not a huge shift from a dollar perspective in terms of dollar strength, I think overall the credit markets in Asia still will be well placed in 2022. Now, in case of Asia, needless to say that what happens in policy terms in China matters more than what you would expect from a U.S. side. So you will have the combination of these factors playing out. But overall, I still think it should be a reasonable year for Asia.
And Neeraj, within Asia, then, do you want dollar exposure or do you want local currency exposure in credit?
I think that's a very, very good question. Overall, I would say looking at the markets right now, in case of China, I would take local currency exposure right now, given the combination of the direction of policy, the local relations with the rest of the world, and the stability of CNY. In the rest of the region, I would still stick with the dollar-denominated credit in the first couple of quarters. And as we go to the second half of the year, I do think there will be significant opportunities in Asia and the local markets, but I would be patient there.
Okay, since you mentioned China, then I mean, I need to ask you about high yield, and certainly, that the angles to the conversation that we've had quite a few since Evergrande started kicking off last year. How has your attitude changed towards Chinese high yield? Have you heard enough from policymakers to make, I guess, a confident enough determination that the pricing we're seeing right now are lower than eventual recovery rates?
So overall, I think the risks are more balanced here than they were 6 months ago. You still have some structural issues in terms of fundamental supply demand, the weakness in the market from the growth perspective, but the policy slowly but to some extent steadily coming back into at least reduce the risk from a cyclical short-term systemic risk perspective. So I think it's more finely balanced. I don't think you can make a very bullish case, but it's not as bearish as it was 3 or 6 months back. And I think some of the policy shifts that we are seeing, it still leads to maybe potentially more defaults, restructurings, asset sales, consolidation, and favors the higher quality names in the sector.
And we have seen some of these Chinese dollar bonds, these developers rally quite substantially on the face of the policy easing that we've seen so far. Neeraj, do you think this is just a short squeeze that we're seeing in the markets, or is it now really a time to increase your exposure to the property sector?
So first of all, the move in the market, and if I look back just the last week, week and a half, it started with short squeeze. And it started with short squeeze on the back of the news around the use of escrow cash in the accounts for the developers. But going into the weekend and coming into this week, we have seen some nibbling or buying back, coming back into the sector. Overall, as I said, the risks are more balanced. Even though there has been significant rally, the spreads still remain elevated. So it gives you a reason to actually look at the sector more from the quality perspective. And if you don't have exposure, might still be a point to think about adding some exposure here, but still very selective.
Oh, and just overall, you probably indirectly touched on this. Just your thoughts on exposure to duration at this point.
So I do think you still want to play from a duration, specifically in the developed markets from the short side. And tactically, you can reduce on the back of these sell-offs. But if you think about the shift in policy, specifically starting with the U.S. and on two fronts in terms of the rate hike expectations, which are obviously going up, but also the quantitative tightening, you will potentially see further steepening of the curve from here. And to some extent, I think the path of least resistance, at least in the near term for the 10-year treasuries, is higher, not lower. So I would still play tactically from the short side and structurally underweight duration in the developed markets.